My name is Michael Duke, and this is my show where I talk about stocks that are interesting. So if you find that interesting, please consider liking this video and subscribing to the channel. We're doing a viewer request today, CoreWeave Inc., ticker CRWV. This came from my grandfather-in-law. He uh, pointed out three different companies that had close ties with Nvidia and was curious to have me take a look and see what my thoughts were. So I'm going to get started with CoreWeave, given that it is the most notable, the largest company of the bunch. So, as always, I'm going to give a brief overview of what the company does. I'm going to discuss its economic moat, if it has one. We're going to take a look at the financials, take a look at the most recent earnings report, take a look at the chart, albeit this company did only IPO in March, so it has a very short-lived trading history. And then we're going to take a look at a few other things, but ultimately, I'm going to give it a grade. So, um, stay tuned all throughout that. As always, I'm utilizing Seeking Alpha to perform a bunch of my analysis. My viewers have the ability to get $30 off the first year of a premium subscription to Seeking Alpha. I'll put the link in the bio there. Also, if you do happen to have an account on Seeking Alpha, be sure to follow me on there where I regularly post analysis and grades as well, in addition to what I have here on the channel. So, anyways, let's get to it. CoreWeave Inc. If you're paying attention to the markets, you might have heard of this company. It is a cloud platform that provides scaling, support, and acceleration for Gen AI. The company builds the infrastructure that supports compute workloads for enterprises. Interestingly, it's headquartered in Livingston, New Jersey. I would have guessed that it was actually headquartered in the Bay Area, given its ties to Nvidia, but that's beside the point. Its products include GPU compute, CPU compute, storage services, networking services, managed services, and virtual and bare metal servers. The company's platform offers a fleet lifecycle controller, node lifecycle controller, tensorizer, and observability. Services also include VFX and rendering, AI model training, AI interference. I think that's supposed to say inference, and mission control. In addition, the company develops a dataset optimization tool for machine learning developers. CoreWeave Inc. was formerly known as Atlantic Crypto Corporation, changed its name to CoreWeave Inc. Interesting. It was founded in 2017 in New Jersey by three commodities traders. It initially operated as a cryptocurrency company mining Ethereum using GPUs. In the wake of the crash, the company was renamed CoreWeave, leveraging its large inventory of GPUs to start providing cloud computing infrastructure to companies. The GPU technology that Nvidia invented is really been the preeminent technology in crypto mining, and that drove a lot of their growth. Cryptocurrency plunged several years ago, and artificial intelligence technology uh, reached a inflection point where it kind of ascertained escape velocity, and the GPU technology that NVIDIA created um, is really the preeminent infrastructure required to uh, both train and operate AI models. So, what is CoreWeave? Well, CoreWeave is infrastructure. CoreWeave is infrastructure that is, uh, it turns around and it rents out to companies. The big data center that OpenAI is building in Abilene Um, that's in Abilene, right? In Texas, in partnership with Oracle. OpenAI, or really the joint venture between those companies, I presume, owns that project. CoreWeave is kind of the alternate model where if big companies that are investing a ton into AI infrastructure, if they were to lease instead of buy, they would lease from CoreWeave. So CoreWeave is like a landlord of AI infrastructure. They buy a bunch of GPUs and warehouse them in data centers and then lease out that compute uh, space to companies that need it to perform their services. So why would a business do this? Well, they would simply do it because it's very capital intensive to have a bunch of GPUs. I think each GPU might cost between $30,000 and $50,000 if you want to buy it from Nvidia. So it's several, 100 million, several $billion on the high end to build out an entire facility. That's really only reserved for the biggest players to be able to take that in house. So really, what CoreWeave does is it allows access to that computational power without nearly the same type of capital outlay. Um, so it's really the same type of business model that a real estate investment trust has in a lot of ways. Any sort of asset-based infrastructure provider, of which real estate is probably the closest analog there. So as you can imagine, the business is very capital intensive. But one thing that is good, and I used AI, I used AI to help me give some context on um, some of the model here that CoreWeave utilizes. And so according to this, and really that comes from Research Artemis, or Artemis Research rather, says here CoreWeave has differentiated itself by structuring long-term fixed price contracts, often 4 to 6 years in length, with large customers who pay significant upfront fees. These upfront prepayments finance CoreWeave's purchase and deployment of the GPU clusters, but as you can imagine, they utilize a lot of debt to do that. Once hardware is deployed after about 3 months, CoreWeave provides cloud compute services and recognizes revenue monthly over the contract's life. This model locks in recurring revenue and secures capacity utilization. In addition to contracted usage, any spare GPU capacity is offered on demand to other customers post-contract, further monetizing the infrastructure. So just like a logistics company who has a warehouse might rent out space, or a landlord might rent out their space, um, or an equipment rental company rents out their equipment. That's essentially what CoreWeave is. It's an asset based business. It's a leasing business, but it just so happens to be attached to this phenomenally strong tailwind of AI uh, that's being built out. So you see here the revenue um, in December 2023. This is pre the time they were public. 229 million of revenue. The following year to 2 billion. So that's almost an 8x. 2 billion to 5 billion to close to 12 billion. So again, these are both estimates here, but we are predicted to double this year and to double again next year off of the tail end of a 8x, 7 to 8x increase in revenue. Okay. Before we take a look at the financials, I just want to talk about, does the company have a moat? Well, um, as far as I'm aware, there's a lot of ancillary services that they can provide in addition to the very simplified model that I've described, and they already have more than just raw infrastructure. We see here, it's made a few acquisitions. In fact, most recent right here, they announced the acquisition of a company called Core Scientific. So they're utilizing the proceeds um, from the IPO and from um, a lot of this debt that they're raising to be able to purchase companies. And like this is a core scientific leading data center infrastructure provider. This is more of a um, data center infrastructure, verticalizing data center footprint. So verticalizing the high performance data center. So there's some sort of data center servicing that they're doing, like some sort of power, or maybe it's just more space or more GPUs. I don't know. Direct control over current portfolio of 1.3 gigawatt plus of gross power. Majority under CoreWeave contract. So they're just kind of bringing that under over design and architecture. I don't want to get too much into core scientific there, but based on the cliff notes there, which is they're basically integrating through the ability to construct data centers to offer the cloud services to customers. So that should increase their margins and speed of execution. What I was trying to say was they can provide a lot of ancillary services by having the GPUs. And so while they don't have this like impenetrable moat, I would say it is capital intensive to hold the GPUs, to buy the GPUs, and to deploy them. And there's somewhat of a network effect from owning a bunch of them. One interesting piece of their kind of more narrow moat, I would say, is that partnership with Nvidia. CoreWeave maintains a uniquely close partnership with Nvidia. This is the 13F of Nvidia, which shows their stock holdings. You see here they have 24 million shares of CoreWeave stock. So they have just over $3 billion of the company. So they own about 6%, 5% of the shares. It's a pretty large holding. It's a pretty large holding. Drop in the bucket for a company as large as Nvidia. But the partnership that they have, because obviously you have CoreWeave is essentially a customer of Nvidia. So if CoreWeave is able to provide this, basically CoreWeave is a revenue generator for Nvidia, and so by building out a steady pipeline of GPU demand, Nvidia ramps more consistent revenue. So that's really the basis behind the partnership. And they because they're an engineering collaborator, CoreWeave has early access to next gen GPUs and the ability to deploy them faster than competitors. Early adoption of cutting edge GPUs gives CoreWeave a head start in locking in big contracts before GPU supply becomes common. So that's somewhat of the network effect that I spoke to. So really, yeah, all they're doing is they're buying stuff and leasing it out, but you can imagine that creates a network effect. They're able to consolidate a lot of ancillary services around that. So do they have a moat? I wouldn't say they have some impenetrable moat, but based on their relationships and positioning within the industry, it's certainly promising, this little niche that they've carved out for themselves. So let's take a look at the financials. Okay. So let's just take a look at this. I'm going to move my face over here so we can get a good look at this. Okay. So in the quarter, we had roughly $1 billion of revenue, 420% year over year revenue growth. That doesn't really talk about whether that's for the entire year or for the quarter, but I guess I assume it's for the quarter. They have a revenue backlog of 26 billion. That's that really stands out. We might want to take a look and see in the footnotes here where we reference that. Adjusted operating income margin, 17%. That's adjusted non-GAAP net income margin, 15% loss. And then we see here $1.9 billion CapEx outlay. We know that because it's a capital intensive business, they have to spend a lot on CapEx to achieve growth. And we'll take a look at their balance sheet, but I assume that they have a lot of debt and a lot of GPUs and that they're writing off a bunch of depreciation. That's what's creating this, although that is non-GAAP. Well, anyways, let's just keep going. Quarterly revenue. Okay, here we go. This answers my question. Wow. I mean, that is phenomenal, driven by strong demand for CoreWeave cloud platform. So, of course, we know Nvidia, that stock really did super well. The numbers told the story of the AI revolution. I think CoreWeave, these numbers are also giving you an idea of how quickly things are moving along. I mean, those are just phenomenal growth numbers. We got, the step up from 1 billion from 750 million is 33% in a quarter. That's really, really strong. So we have our adjusted operating income, and we're gonna take a look at that and see what we can ascertain from it. It might be complicated enough. I won't be able to make quick sense of it without really spending some time, but we'll try. Adjusted operating income was 163 million, up 550% year over year. I mean, that's just Looney Tune like numbers. Adjusted operating margin up 3 points. Ramped investments to meet customer demand, continued investment in sales and marketing to grow and diversify customer base. Despite the strong growth, we're showing a steepening loss, adjusted net income loss. We're showing a steepening loss impacted by higher than expected interest expense due to reduced amount of interest cost capitalized in the quarter. They're utilizing debt, I would assume, to fund their build out. Even though they're showing a profit here and they're showing a loss here, their adjusted EBITDA margin is above 50%. I mean, these numbers are wacky. Like what kind of adjustments are we making here? But nonetheless, this tracks pretty crazy. We got almost a 6x increase in adjusted EBITDA over that time. So that looks really good. But the numbers are so all over the place. It's enough to make me look and just be a little bit skeptical. Not skeptical that they're successfully growing fast, not skeptical in the least that they are, just skeptical about the adjustments they're making. It does appear that they have some really aggressive adjustments. Revenue backlog, 15.9 billion to 25.9. So a $10 billion increase, up 63% year over year, driven by OpenAI strategic deal signed in March. Revenue backlog means the remaining performance obligations is the aggregate total of our committed contract that are yet to be delivered to our customers, inclusive of both billed and unbilled amounts. Revenue backlog includes remaining performance obligations plus subject to the satisfaction, yada, yada, yada. Other amounts the company estimates will be recognized as revenue future periods under committed customer contracts. So obviously that's a huge amount, but it's unclear when it will be recognized. I do find it a little bizarre that they are including something like this. But I guess it's not that different than a real estate development company, including something like this in their slides. I don't really cover companies like that, but I guess it wouldn't be too off from something like this. Capital expenditures. Q1, $2 billion, quarter over quarter, driven by timing of data center capacity coming online and new generations of GPUs being placed into service. Cash paid for property and equipment, including capitalized internal use software, was 1.4 billion. So 1.4 of that property and equipment, $1.9 billion of capital expenditures, $1 billion of revenue. it's not like I shouldn't say red flag, but in every single one of these quarters, we have, spent money on capital expenditures far in excess, in multiples of our revenue. So that money has to be coming from somewhere. It's being externally funded by uh, debt and equity raises. Of course, they didn't go public until this quarter, right? So it's conceivable to think that they have raised a bunch of equity rounds over the last few years. I don't have that data in front of me, but again, I would assume you get the idea. There's a huge amount of money being spent, far in excess of their revenue, not even their profit. So this is a lot different than a lot of companies I cover, because I'm usually taking a look at companies that are not as early stage as this. But I wouldn't say that there's anything wrong with this. I think what matters is the pace of revenue growth and what that means. The fact that they're even showing an adjusted operating income, yeah, they're doing some crazy sort of accounting trickery to get to that. Of course, capital expenditures net out after that, because that's how they're growing their footprint. And you see here, um, 33 data centers, 420 megawatts, 1.6 gigawatts contracted. That's interesting. A small footprint in Europe. Um, but yeah, you got DFW. This is Austin or San Antonio. Lots of capacity in Georgia, all up the West Coast, in the Midwest. Our data centers are purpose built for AI. Okay, so here's a little bit more of a thought experiment here on what they're doing. You see here, we've got kind of this like foundational layer of the infrastructure, and then they're building out all of these services on top of this. Now, I don't have the technical chops to be able to um, explain in depth right now how those all interrelate. However, I think it's very common sense how, when you own the infrastructure underneath, how the spillover effect creates on top that you vertically integrate. And there's no numbers that we're looking at here, but it does look very sexy. It does feel very sexy. Everything about it is very it makes a lot of sense to me, and I really like what they're doing. I really like what they're doing, but I will say this is very early on in the stage. I mean, they just show their RPOs here, 184 million of stock-based compensation. Look at all the stock that they've been paying out. Man, huge losses. Yeah, so this is a real simple diagram here. Um, 1 billion of revenue over the last year, or excuse me, this is the quarter. 1 billion of revenue, 1 billion of operating expenses. So that's not bad. Like, they're basically right at the break even. Last year they were actually a little bit above that. You see here, operating margin went down. So their margin profile is really weak, and they're not even they're running at an operating loss. But you see here, the interest expense is really prohibitive there. You've got a 420% increase in revenue, however, a 549% increase in interest expense. I don't want to read into that too much, but that's certainly not a good trend there. So on that, very simplified net loss of, negative 32% versus a negative 68%. So by that definition, they're certainly tipping the scales in the right direction by that metric. But then, where was it? Right here, there's all your adjustments. I'm not gonna some of their adjustments here. Quite a lot of stock-based comp. So that was one of the line items that they had. Okay, well, I guess that's not bad. In other words, stock-based comp was included in that, which is good, but we know that it's a non-cash expense. So That's a little bit more palatable. Okay, here's what I wanted to look at. So this is how we're adding back our adjustments. So right here and there, we're 315 million of losses. 443 of that is depreciation. So we definitely add that back in. Interest expense we should not be taking out, in my opinion. Stock-based comp is a little bit more nefarious than depreciation, but if you add back depreciation and stock-based comp, you're at 620-ish back on top. So you're actually not really bleeding as much money as it seems. These other things, taxes, gain loss on fair value adjustments, um, interesting what they're doing there. That makes the numbers look a lot better to me, actually. Because I'm a real estate guy. I depreciate the properties, take the loss. It helps from a tax perspective. So the fact that they're showing all this depreciation, just by adding that back in alone, we're seeing a profit. I think EBITDA, again, their EBITDA being 606 million, adjusted EBITDA. Um, of course, I want to know what interest expense is, but yeah, get rid of that for EBITDA. They're still spending $2 billion rounding up on CapEx versus the 606 million of adjusted EBITDA. So look, I tell you what, that gives you everything you need to know. If you are analyzing this company, you must not look at these numbers here and take those as word and bond, because you really, I think, to appropriately measure the performance of the company, and how much cash flow it has, I think, get rid of the add back the depreciation, and that gives you an idea of what their cash flow is, and maybe add the stock-based comp as well. Add those back in, and in this scenario, you really have 300,000 ish of cash flow before interest and before capex. So that actually doesn't look too bad. It doesn't. Let's take a look at their balance sheet. I'm just going to do that directly from here. 1.3 billion of cash, 1 billion of AR, totaling 3.1 of current assets. So 19 billion of gross property, plant, and equipment. So 20, yeah, I mean, there you go right there. So that's how they're writing off so much in depreciation. Current liabilities 7.1. You see here 3.7, 3.8 even of current liabilities, or excuse me, of current portion of long-term debt. 1.2 of accounts payable, 5 billion of long-term debt. What about short-term debt? Yeah, it's all long-term, but they have a current port. I mean, 1.3 of cash and 1.1 of receivables versus 7.1 of current liabilities. Um, Man, the balance sheet don't look too good, folks. And look how dilutive the share count is. Again, that's from December to March. So they've issued a lot of equity and debt to be able to fund these capital expenditures. So that's really the limited visibility we have there. I just want to do a brief technical analysis before I give my thoughts on everything. I don't think the trading history is long enough, but we're kind of bouncing off of this zone here, and we're kind of at a key technical level. If we break down below this, it could fall all the way back to below 75 potentially, because there isn't really a clear level of support. But if we bounce above this, I mean, we can go all over the place. So it's pretty early to do a common sense technical analysis, but I think where we are right now is a good level, and I'd be curious to see where it goes from here. Here's the deal with this. I think that the growth numbers are phenomenal. You've got a good story. So the market should love this stock, and in fact, it has. It traded from it IPO'd at like 30 something, I think, and it traded all the way up to 180. So that's a six x in just a few months, and we've seen it calm down a little bit. So I could see why the market would love this stock because it's directly tied to AI tailwinds, and the growth story is there. However, the business model that they have um, is just vomiting cash. The amount of debt and equity that they've issued, even this acquisition of Core Scientific, um, is an all stock transaction, a fixed exchange ratio. Just think about that, right? We're issuing stock to make acquisitions of already diluted shares. We've got lots of interest. The growth story. There's a lot to like. The people who own or who manage this company appear to be total cowboys, and I mean that in the most appreciative way possible. Um, I like their style. They're clearly very risk tolerant individuals, and they appear to be positioning the company for success. One thing that I really like is the track record there, where they had all these GPUs. Things with crypto weren't really working out, and they just pivoted, and now they've hit their mojo, right? And they just continue to double down on that. So I think that there's uh, a lot of promise in the management team, but they are in an early stage of growth, and I would not expect it to show strong profitability anytime in the near future. And I would expect the earnings to be very volatile. Um, and if you are interested in investing in the company, I actually am. I'll say that I'm interested. It's sexy. It's sexy, but it's not at a level where I would weigh in or I would enter with a lot of conviction here, just because we're at a technically challenging level that could end up being a good entry point. So it might be worth a speculative. This is a speculative investment at the current price. But I do think that there's a lot of long term upside. I think the main risk factors here are you just have a lot of interest rate risk. You have it, you have a lot of interest rate risk. You have a lot of execution risk, and you also have a lot of customer concentration risk. Um, because right here, the revenue mix in 2024 was highly concentrated. About 60% of sales came from Microsoft Azure, and the top two customers accounted for 77%. This implies the majority of revenue is tied to multi-year enterprise contracts. If Microsoft decides that they're going to bring all that in-house and they're going to build all their own data centers, that's going to severely hamper CoreWeave's near-term financial results. And given that they have not a great looking balance sheet and they've issued a lot of debt, I expect this stock to be phenomenally volatile. But it could be a good one in the long term. But I would say if you're investing for the short term, like a 5-10 year time horizon, even, I would think twice about investing in this because it's already at a $60 billion market cap. I mean, we didn't even talk about the valuation. Let's talk about the valuation. The valuation of $4 billion, $4 billion um, in the last quarter, growing quickly, but let's just annualize that. That's $4 billion of revenue. That's a 15 times price sales. I don't know where they're getting this number. That doesn't look right. 15 times sales. That's pretty aggressive, right? And there's 15 times sales, 30 17 times price book, and it does appear that maybe the either the numerator or the denominator here might not be completely accurate, which is totally normal given that it's a brand new company, and they utilize the information that's through here. So I don't really think that the valuation that it's at here is very appropriate at all. But with a small amount of capital, entering a tracker position, I think is appropriate because I really uh, believe in the story long term. I like asset based businesses that have a model like this. I like businesses that are able to take a bunch of depreciation on paper, that allows them to save on taxes and invest in other ways. So there's a lot to like, but the risks are clear. You have an insane customer concentration risk. And so it's hard to get excited about this, about the current stock price. But I think there's enough there that if you're a growth oriented investor, you want to get more exposure to AI. I feel like this is a company that you probably need to have in the portfolio, even if it's a small position. I see a lot of risk to the upside, a lot of risk to the downside. Um, so I would want to see how their results look for several quarters before jumping in with more conviction. So I'm gonna essentially grade it as a hold right here, um, and really that's spiritually a hold. Like, it's not super exciting and super compelling at the current price. However, the technical level that it is in here is certainly interesting. I might consider buying some here, but I would have to sell another position and I would do it in my IRA because that's the long duration portfolio. I wouldn't be able to allocate a large amount to the stock and wouldn't, and so it fits my goals that way. But yeah, I think there's better places to go in the market for growth. Obviously, if you invested in it in the lows here, that would have been a much better place to buy. But hindsight's 2020. So I like the company a lot. I like what they're doing, but there's a lot that I don't like either, and for that reason, I can't give it a glowing review. But I think that there's a lot to be excited about, and I'll definitely continue to watch the stock. I'm going to add that to my interesting companies watch list here in Seeking Alpha, and I'll continue to monitor this one because I do really like it. So thank you to Dave for the heads up to take a look at this. I've got a few more to get to. Um, over the next few days of being able to do that. But this is certainly an interesting one, and it definitely has tons of potential, but it's going to be a volatile ride to get there. And there's a lot of things that could go wrong, at least in the interim. But I think long term, assuming that the founders continue to execute the way that they have been, there's a lot to like. So that'll conclude our video today. Hopefully you found this interesting and useful. I've had a good time showing it to you. Again, be sure to like and subscribe if you found this content useful and you want to see more of it. I cover new companies all the time, and I love to hear from you and take your suggestions. Take a look at things I never would have considered otherwise. So please feel free to leave me a comment and let me know what you want me to look at, and I will consider. I won't guarantee that I'll look at it because some of the suggestions have not been good, not been worth it. But anyways, leave me a comment and let me know what you think. And until next time, I'll see you later. Have a good rest of your day, and thank you for watching.